Hey everyone, welcome back to the Broker Life Podcast. My name is Mark Panazon. I'm a mortgage broker with Mortgage Connection. I've been licensed in Alberta and BC to do mortgages and have been doing mortgages for the last 15 years. Today's guest is Ashish Utarid, Assistant Vice President at IG Wealth Management. Welcome to the show, Ashish.
Yeah, thanks, Mark. Thanks for having me.
No problem. So let's get into it. Why don't you tell our guests a little bit about how you ended up in the financial services industry and at IG Wealth Management?
Yeah, so amazingly, it was almost 20 years ago. I started with a major bank, and at the time, internet banking was just coming out as a newer concept. We were building out our self-serve banking models, and the call center that I started in was a big driver of my success and kind of opened the door. I was pretty successful at making sure clients were serviced, and I ended up getting invited to write the Canadian Securities course. And I didn't realize at the time that the Canadian Securities course opened so many doors for young people in the financial services industry. And it wasn't a few more months that I was on the mutual fund desk helping clients, rebalance their investment portfolios. And that's when I really fell in love with the investment side of the business. That lending side, commercial banking, that was never a passion project for me. And so I just really loved helping clients understand investments, financial literacy, and just making sure that they were making the right choices with their savings and achieving those long-term goals. So it's been, yeah, this will be my 20th year in the business.
So what is it about let's talk about your position. So what do you do? What's your actual job?
Yeah, so as Assistant Vice President of Investment Strategy, we have a team of three. So I'm based out of here of Edmonton, Alberta, kind of taking care of the West. We have my colleague, Pierre-Benoit Gauthier, who is Assistant Vice President in Quebec. So he's our French speaking, macro, like I guess you can call it. He's our French speaking representative out there. And then we're led by Philip Peterson, who's the Chief Investment Strategist. So this is a relatively new team. We started about a year ago, and all of our kind of mandate is to get out into the marketplace, educate our clients and our prospects on what's happening with the market, make sense of the trends that are dominating, everything that they're talking about, and we try to make sense of it all in a very easy to digest, version. So I do a lot of road trips. We'll travel out to Victoria, Vancouver, Kelowna, Calgary, Regina. Those are kind of my territories that I take care of. And I'll do speaking events. I also go into the region offices. So every office would have some training or anything that they need to do. So I partner with the local branches and I just make sure that everyone is up to speed on what's happening with the market and that macro perspective. We also sub-advise on our kind of like flagship product. And so we make sure that we do the we call it geographic tilts. So we kind of steer the ship in the right direction as we see the economy going. So that's kind of our other kind of side mandate.
So you're working directly with your advisors, not with clients, right?
So yeah, we're working directly with our advisors to educate them, elevate their knowledge, make sure that everyone is kind of understanding what's happening in the market landscape. But on the client side, we do client presentations. So just making sure that they, you know, see us, hear us. We have our podcast, which is every Friday. We do the weekly blog on Fridays as well. And then we also do our quarterly videos. And so those are all client facing, ready to go.
Okay. So you were managing a book prior to this position, right?
So prior to this, I was actually a portfolio specialist. I actually did portfolio construction and design for high net worth clients. So clients that had over 1 million in assets, I would build out their portfolio. How much US, how much Canada, how much bonds, how much international, and we would design their portfolio based on their goals and their risk profile. Prior to that, I did have a book of business at a competitor, and I was kind of moved out of managing clients into managing the assets.
Mm. Which one do you like better?
I love managing the assets.
Yeah.
I think clients need a special type of advisor, the one that can really almost be their best friend, to understand everything that's going on with their families, to pick up the phone at Friday at 5 o'clock in the afternoon. I have a young family, so in this moment, it made sense for me to just focus on that analytical side of the business, make sure that I had a lot of knowledge and confidence going into like public speaking and all of the things which I love to do. And my biggest passion is financial literacy. And I feel like impacting 200 families would have been very, very prosperous and amazing. But in the role that I have now, I can impact tens of thousands of families. And that's really what I want to do. I really want everyone in Canada to understand what finance is. It's not scary. It's easy to understand if you know what to look for. You know what to ignore because there's lots of noise in the marketplace. And I can do that with this platform.
Would you say that you have an investment philosophy?
Yeah, I would believe that investment philosophy is investing is a lot easier than people think. And by outsourcing the things that you don't know how to do is the best thing for your long-term objectives. And so the number one thing when I sit down with a client or a prospect is to understand what makes them tick, what is their relationship with money over the last 10, 15, 20 years, what did their parents teach them about saving, maybe they didn't get any knowledge in that at all. And when you have someone with, say, a low knowledge, low risk profile, low engagement, they just have full trust and they say, okay, just do whatever you think is best. That's our job, to elevate and educate. And when you have someone who does a lot of reading and they do a lot of researching, and research can be Twitter, research can be Google, research can also be reading books, and that's all okay. But to have a dialogue and a discussion, that's really what matters. Because if a investor comes to you with their investment philosophy and it doesn't match with yours, it's actually better probably to move on to someone that matches your values. Because on our end, or at least the investment philosophy that I believe in, is that sub-advised model. So choose your risk profile, be very deliberate, asset location, asset allocation, that's very important. Take risk where you need to, and then also understand what your goals are, right? So you have to look at your budget today to understand what you're going to be spending in the future. You have to look at mortgage rates. A lot of people in our business only focus on the investment side of the balance sheet, and our firm focuses on both sides. We look at the debt side, we look at the asset side. If you don't manage those two components, you're not going to hit those milestones, because you can make them a lot easier to hit if you're managing the debt side of the equation as well. So yeah, my investment philosophy is outsource what you can. You can't, as an individual investor, you'll never be able to figure out bonds, international equities, emerging markets. There's ETFs for that. There's mutual funds for that. That's the easy part. And Canada, US, making sure that you have the right balance of all of those equities. And then obviously we believe in advice. You can get a lot more value from tax planning and legal planning, because a lot of what you're saving for, it might be for the next generation or for your retirement. And if you're just doing things inefficiently and you're just paying more tax in the future, and you're not getting the advice you need today, you might be saving money on advisory fees today, but you're not saving on taxes in the long run. And so you have to balance those things.
Is there such a thing as a set it and forget it portfolio?
I think in the beginning, yes. I feel like if you're, new to the workforce, 16, 17, 18 years old, and you're just starting out with your first, investment account, or you want to try, one of those online brokerages and just kind of play your hand at it, there's a lot of products that are catered to that young person where the rate of return doesn't matter. What matters more is the habit. And young people need to understand that if they can save 10, 15, 20% of their gross income up front in their early 20s, that by the time they're 30 or 40 years old, they will be so far ahead in their investment, or I guess their savings balances, that they will have so much more freedom to take risks in career. They can take risks in opening a business. And starting early is really important because the rate of return doesn't matter at that point. You just have to just keep plugging away and putting money into, a well-diversified set it and forget it portfolio or ETF or anything like that. Once your needs become more complex, right? You start to buy a home, maybe you buy a second home. Your goal is to have a cottage, or buy a houseboat, or anything that's kind of has a big price tag on it. That's when you need advice. If you're self-employed, and we have a lot of contract workers now in Canada, right? They're working for American companies. They're maybe even getting paid in US dollars. When that complexity starts to hit, that's when advice really starts to matter, because you can, just in tax alone, you can pay for your advisory fee, avoiding the common mistakes that business owners make, not paying themselves enough, or keeping too much in their corporation, or the opposite, spending too much in the corporation and then having to pay a big personal tax bill at the end. There's so many ways that we can structure your expenses, but you just need to have the right program for that.
So the household debt to income ratio or figure is like 180, something like that. So for every $100 you earn, you're basically spending $180. This is outrageous. I think it's
Yeah.
the worst in the G7. People are having a hard time saving. I watched a YouTube video last night. This Chinese sort of investor group, and he sort of compared the cultural differences of the way Chinese people save money and like Western societies.
Yeah.
And there was a chart he threw up that was really fascinating. He said, on average, Chinese families, probably in China, save like something like 49% of their income,
Yeah.
and America was something like 5 or 10%. Why is there not so much on the cultural part of it, but just the whole idea that savings isn't really valued or important in even just Canada or the Western world? Why is it such a low bar? There's another book that I think it's The Wealthy Barber that talks about saving 10% of your pay. So these are all good ideas, but why is it so low? And why aren't we saving more? And from your experience being with clients and advisors, are you noticing those sort of same trends where people are having a hard time saving? They don't know how to save. They're not putting nearly enough into their retirement, or is it a completely different picture from your point of view?
So I think it's actually both things. And so the actual stat at the end of December 31st, I have it up here, is $182 of debt for every $100 of income.
Yeah.
You compare that to the United States, which is around par. So it's about $100 in debt for every $100 in income. And normally, up until 2008, Canada and US was neck and neck. The difference is that in Canada, housing costs and these mega mortgages have really increased that debt to income ratio, and it's actually really scary. And I say that in a sense that it doesn't keep me up at night, like I'm not losing sleep over it, but I know that a lot of individual Canadians are, because we're having, what the second part of your question is, we have this kind of dichotomy, right? We have this barbell effect of the economy, where you have families that are just doing the best they can to live a good life in Canada, but have accumulated a lot of debt in order to pay for it. They've got the car payment, maybe they have a second car payment, they've got the mortgage, their credit cards are starting to get balances if they're not already maxed out. In the US, after 2008, anyone that was over leveraged was able to walk away from their mortgages and basically reset their balance sheet. That doesn't happen in Canada. You can't walk away from your house in Canada. You owe that debt forever, unless you go through other channels to refinance or mortgage or bankrupt or any of those other channels, which means that people are carrying large amounts of debt. And on top of that, when you have housing prices and a housing shortage in major centers like Toronto, Montreal, Vancouver, and even now like a little bit in Calgary, like
Yeah.
you've got these huge mortgages, high ratio mortgages as well. Like people are putting down 5%, and they've got so much debt to their equity, right, on in housing alone. That's really just ramped up this scary number. And yeah, you're right, it's the worst in the G7. It's one of those things that's really going to impact our economy over the next 3 to 4 years. So if I'm making, say, 100K a year, and my interest costs might be, whatever, I don't know, 3,000 a month, and my mortgage comes up for renewal in a couple of years, and now my interest costs go to like 5,000 a month, that's money just being taken out of the economy. That's money I can't buy cheeseburgers with. That's money I can't go to the mall and go shopping with. And so when you start to like extract money out of people's wallets because they're just going to interest costs and debt repayment, that's going to have a huge impact on our economic growth, like just here in Canada alone.
That's a good segue. So inflation's been the hot sort of number, figure, stat, headline over the past couple of years with COVID, obviously, and rampant government spending. There's another chart out there that shows Trudeau spent more money through COVID than all of the prime ministers combined in Canada's history, which is wild. It's easy to place blame on the government for that amount of what looks to be irresponsible spending. But at some point, everyone's going to deal with it. They've obviously, it looks like they've gone too far. Inflation shot up to around 8% at the peak, but we're back down to 3.4%. It took what, 9 rate hikes to do it.
Yeah.
It sounds like there's going to be another one in a couple weeks here. So with the inflation being out of control, coming down, but still like very high, interest rates now very high, mortgage payments very high. People having even less money than they did before. We already know the debt to income ratio. What's your advice for people to how to manage this time to get through these hard times when costs are so high?
Yeah, so inflation is a huge, call it call it tax to the consumer, right? Like if I had $100 today to buy anything and I decide to defer that purchase for a year, I now have $95 available for that particular item.
Hmm.
And there are certain things over the last 3, 4 years that actually went down in price. So smartphones, big screen TVs, all of those types of electronics, things that were in high demand in 2020 when people were locked in their houses, all came down in price in 2021, 2022. The types of things that have really driven inflation is on the services side. So when you really dig into the numbers, people are traveling like crazy. They were basically locked in their homes and they couldn't travel. So airline stocks went down, Carnival cruise ships went down. Like all of those cruise ship companies went down because people couldn't leave their homes. And then when the economy started to open up in 2021, we had what we call the rapid reopening. Everyone was driving up demand, and they had stim checks in their pocket. They had, uh, the emergency funding from our federal government.
Sturb, yeah.
Yeah, we had mortgage deferral. Do you remember when you didn't have to pay your mortgage for if you got approved for up to 6 months? And so that level of savings in North America alone shot up. And so you had this massive increase in savings rates. And then you had almost an overreaction the following year to spending.
Yeah.
Now, when you have a limited amount of like if you have a limited amount of supply of goods and you have high demand for those goods, you are naturally going to have inflation. So we call this the velocity of money. Imagine if you live on an island and there's only a $100 bill on this island and it changes hands between different people on the island. But then the government comes in with a helicopter and puts $100 million on that island. Naturally, the services and goods on that island are going to be about the same, but now you have $100 million to go around all those people, and so the price of those goods and services are just naturally going to go up. Okay, that's like my very crude analogy of how that works. And what's been happening over the last 2 years is that the governments, the central bankers, the Federal Reserve in the United States and here Bank of Canada are trying to extract that money out of the economy, right? So they're trying to reduce the velocity. But exactly what you said is that too much in a high amount was given to every single individual, regardless of class. And you have people on the low end of the income spectrum that sort of used it to survive and they did exactly what they needed to do. And those are the people that needed the help. And then you have the other kind of middle class that they might have had a couple of months of, hardship, but then they were able to continue to work from home, right? We thought everyone was going to be laid off in almost every sector, and that just didn't happen. We shifted to this hybrid work model. People were still getting their paychecks, but they didn't have to commute to work. So again, this created a lot of like capacity in the economy. So people started spending. And then you have the kind of the higher end. The higher income earners didn't really have any effect. They might have seen that in their purchases, like it was a little bit more expensive to, fuel up my car, or like, I have to take care of other things that they have, like all of the goods that they continue to buy, or they decided not to purchase those big items, or they put something into real estate. So we saw real estate prices go up, we saw renovation costs, all of those things go up. So all of that demand in 2021 kind of came to a halting crash in 2022. That's why we saw a lot of volatility last year. And now we're working through that in 2023. Interest rates have to go up. They have to slow down the economy. I don't know that they're done with the interest rates. At the beginning of this year, our view was that they were likely done by the middle of this year. Inflation has started, it continues to trend downward, but when you look at what's falling off next 2 to 3 months, there might actually be an uptick in inflation. And so that's one of the things that the Bank of Canada and the Federal Reserve are looking at, is that we had this huge spike in inflation due to the Ukraine and Russian war. Commodity prices went up, oil prices went up all of April, May, June last year. And so those are all falling off now. And so now we're going to see another, big spike or sorry, we're not going to see a big spike in inflation, but we're going to see an inflation spike a little bit, unless we start to slow down this economy. And it's all services driven. So I mentioned earlier, airline travel, restaurants are packed. I was recently in Toronto, and downtown Toronto in the evenings, every restaurant was like completely packed. And I was there on a Monday and a Tuesday. So it's just interesting to see, who's spending money and in what areas.
Yeah, I would agree, and I think with the commodities coming down, that's going to help, and that has helped. But shelter costs, right? What's going to impact the shelter costs? What's going to impact rents and mortgages coming down? If you go back and look at any chart, uh, inflation and the Bank of Canada yield, they kind of work in unison, right? That's the major tool that the bank has to slow inflation, is to increase rates or reduce rates. So inflation's coming down, so the rates will come down in the future. That's inevitable. To what level or degree, nobody really knows. So that will help with the cost of mortgages, but that's just really the burden of the existing homeowners and mortgagees, right? Or mortgagers. So what about the actual like supply problem that Canada has? And we don't have to get too deep into the weeds with this, but just a general take. What's your general take on the supply issues and how we can try and provide more homes so that base cost comes down, which will lower the CPI, which will make it more affordable? It's almost a trickle down effect, because it seems like, um, I'm just looking at the Stats Canada basket weights for the CPI, and I think shelter's 28% of CPI. So roughly 30% of inflation goes towards housing. So that's obviously a massive issue. So what's your take on that?
Yeah, I think the biggest thing is if you strip out that particular component from CPI, you're looking at inflation in the target range of 2.5%. And we need to be very clear with our audience is that the Bank of Canada's mandate is to have inflation at 2% plus or minus one.
Mhm.
Okay. And we had low inflation for over a decade,
Mhm.
right? From 2008 to 2018, almost to the time the pandemic hit, that we were in a very disinflationary environment. Inflation wasn't a problem in our economy. But when you have all that massive stimulus hit the market and you have all of this money floating around, that drove prices up very quickly. And that includes real estate prices. And I'm not sure if you saw the uptick, you could tell me a little bit more, but like people were trapped in their homes and they literally were like, no, I need more space, right? I need the home office. I need an extra bedroom. They're looking at all of the things. And so the real estate activity in 2021 ended up being much higher than it was previously. Factor also that a lot of rental capacity has now switched over to short-term rental capacity. And you've got these short-term rental companies that are offering these properties in major centers, right? Toronto, Montreal, Vancouver, right? And those particular property owners would rather earn that income on short-term rentals than have capacity for long-term. So there's that issue as well, and that will work itself out as the market adjusts and maybe more properties come on board or more specialty properties come on board for short-term rentals. And then the third thing is we have a high demand for everything. Like we have um, government mandated immigration to backfill our job vacancies. We have a low birth rate in Canada, which means you have less people being born in this country to backfill the jobs that are required to grow our economy. And that's why we have this huge mandate to bring in more outside work, and which is all great, but that creates a demographics issue, right? Because you have the influx of people, and they're not going to move to, podunk Alberta, or small town BC. They want to move it to a major center, and these major centers need to have a big policy shift. And so how do you get, you know a new home buyer into a home that's reasonably priced? The average price of a home in Canada, isn't it, I believe it's over 700K, which means that it would take almost a decade just to save up enough for your down payment, and then you have, you know the mortgage costs and all those other things. And unless you come here with a bag full of money, you're priced out of the market, and that's creating pressure on rent. So we call it owner equivalent rent. We call it your mortgage housing costs. Those are all up, and it doesn't seem to be. There's no pressure, and I think from this point forward, there needs to be intervention either through the government or through massive building of capacity of reasonably priced homes. But we live in a market society, right? Market driven prices. Builders have their costs, and if their costs go up, the building house costs go up as well. And so it's really tricky to sort of figure this out. And I'm not a policy guy. Like, I wish I could just wave a magic wand and just say, okay, we're going to build 200,000 homes in Alberta tomorrow, and that'll give enough capacity, right? That is part of the problem, is that we rely on private investment to deal with the real estate problem.
It's a real challenge. You have all this space in Canada, all this land available to us, yet it's one of the most expensive in the world, especially, Toronto, Vancouver. It's very odd. And immigration's interesting too. All these people coming into Canada looking to buy a home, looking to start their life, and basically pouring fuel on the fire for house prices. It certainly does seem, from my standpoint, that government seems to be in the way. If there's easier policy involved to get more homes built faster, and if taxes were lower, then you'd think that more private investment will come in, and that would be appealing to them if they have cheaper financing, easier rules, or faster times to get permits and planning in place.
Sure.
But isn't it that kind of a scapegoat just to say it's the government's fault? Is there something deeper here, something bigger in Canada happening that is unlike even just the US, where it's like far more affordable and they're very similar economies in a lot of ways? Or do you think it is sort of a political thing? And again, we don't have to get down the rabbit hole of, liberal and conservative, but it seems to be an issue in Canada, and I don't know why.
Yeah, no, I agree it's an issue. I don't have a solution that's, in front of us. And like, when we rely on private investment to take care of these types of things, you expect there to be a market. And so, if I was a business owner or a home builder, and I said, okay, I'm going to get into the low income housing space so that people who make, less than 100K can afford my homes. Once it's on the market, it doesn't, you lose control. And so that's where the policy has to come in. We're like, okay, we're going to build low income housing. We're going to build housing that's affordable for, multifamily, kind of like zoning, all that kind of stuff, in areas where we can, like, stimulate the economy. And, I can give an example. Like, here in Edmonton, we had the old airport, the downtown airport, completely leveled, repurposed, and now you've got sustainable housing development. And it sounds amazing on paper, right? Geothermal energy that is pumped into the streets so that they don't have to do snow clearing in the wintertime. You got solar panels on every house, so you've got this like sustainable community that they're trying to build. And guess what the uptake is for that particular neighborhood? Dismal, right? Their projections were like sold out by XYZ year. And where are people actually moving? The suburbs. They're expanding out. And that's just here in Edmonton. Like, I don't know the intricacies of all the other economies, but like, private investment wants to get it right, and they are trying their best to cater to those types of economic principles. But the issue comes down to the consumer. The consumer wants these McMansions, they want big houses, and they've got decent incomes, and so you end up with a $400,000, $500,000, $600,000 mortgage, and you're living paycheck to paycheck. And then that doesn't help our business, because our business is about saving and capacity and making sure that you're hitting those long-term milestones. And yet in Canada, we have this focus that real estate is the only way to build wealth. And it's not. There's a difference in building wealth and being house poor. And so we want to really make sure that investors and clients understand what the difference is. That all comes down to education.
Yeah, you're bang on there. And it's funny in my industry, we're doing pre-approvals all day, right?
Yeah.
So we take their income, we take their debts. It's basic math, debt ratios, and then we figure out what's your max pre-approval. This is a big component of our job as brokers. So we're issuing these max pre-approvals, which go right up to the 44% debt ratio. And people are going shopping for that amount. And we can advise as much as we want and say you should be closer to half of that. Like, let's aim for a 20% debt ratio, give yourself breathing room. But when house prices are high, there's limits. Now, you can maybe get away with it in places like Edmonton, but I mean, any other big city, Calgary, anywhere in BC, anywhere in Ontario, I mean, it's expensive. So it's interesting how this is going to shake out. It's, even for our family here in Victoria, we moved here 2 years ago. We're renting a house, and the cost of our home was the same as our detached home in Edmonton, 2 years ago, before the rate increases. And if we were to buy this home, it would be 2 to 3 times our home in Edmonton easily. And we can't afford to downgrade, or not necessarily afford, but we don't have the space to downgrade, right? Like, we're already in like a bi-level 3-bed 2-bath house. If we were going to go into a townhome or something, kids are sharing rooms now, and you're still over $1 million. It's bananas. And so, the prairies are going to be okay, I think, for
Yeah.
housing. But on the coasts and the bigger cities, I mean, these are real problems. And when we start talking about foreclosures and bankruptcies and maybe unemployment going up, like, it'll be very interesting to see what happens. Okay, I want to change the topic just a little bit. I want to get your take on the current economic cycle. So, macro, broad view, we have been in COVID, or are hopefully done with COVID soon here, but now it's all the aftermath, right? The government spent all this money, inflation's up. We're on the way. We're on the right way. Where are we kind of in this cycle? Are we in a recession based on your data and your information? Are we headed for a recession? And is it going to be a soft landing, a hard landing? What's going to happen here, and what's on the other side?
Yeah, so at the beginning of this year, when we look at all the data, we looked at how inflation was affecting the economy and all of those factors. And I'm talking just 6 months ago. We were expecting kind of a recessionary, and let's define what a recession is. That's 2 quarters in a row of economic decline, and that's GDP specific. What kind of is like a juxtaposition to that particular view is that the data is screaming at us that we're in a recession or heading into a recession. And so there's kind of like 7 metrics that we look at. And I'm going to go through a couple of them.
Right.
So I'm not going to get into an inverted yield curve, but I will explain what that means. An inverted yield curve means that your short-term rates are typically lower than your long-term rates. And when there's an inversion, that means short-term rates went up higher. And that's exactly what we saw, 400 basis point increase in short-term rates. And that creates what's called an inversion. So that means that your short-term money costs more than your long-term money. And so on the long tail end of your 10-year bond, you might be getting 3.5%, but your today bond is getting 4.5%. Okay. And so that creates, so that particular indicator has been right like 99% of the time. So when you have an inversion in the yield curve, at some point in the 12 to 18 months that follows, you're going to have some type of economic decline. And recessions are not something that people need to be scared of. It just means that the economy is slowing down. Now, we could argue that we need a recession to bring down inflation. And we talked about inflation and how it's already been quite impacted, and the central banks have done a good job up to this point. They just haven't had enough time to let all those interest rates kind of work its way through the economy. That takes about 12 months as well. The other metric we look at is declining manufacturing output. And so manufacturing, and we use the PMI, or the Purchasing Managers Index, manufacturing index, as a kind of key gauge. That particular gauge was bright could call it bright green. So every particular factory was like full capacity in 2021. In about 2022, they started to see a bit of a decline. And at the end of Q4 last year, manufacturing has been in contraction territory globally. And there's only a couple of economies where they've been growing in manufacturing capacity. And what that means is that when manufacturing starts to be in contraction territory, that means the consumer is ordering less things and factories are not building as much stuff. And when you have factories not building as much stuff, you have wages go down a little bit in the factories. Shipping from China to North America becomes a little bit how do you call it, faster, right? Because whatever they have in inventory, it just gets over to North America. In 2021, it cost a shipping container almost $22,000 to cross the Pacific Ocean, and now we're back down to 3,000 pre-COVID levels. So that's one of the reasons why inflation was thought to be transitory, because it was just too expensive to bring stuff over. So we're in a manufacturing recession already right now, and that's going to trickle through the economy with cheaper goods. I'm not sure if you noticed, but like Black Friday in the United States and Christmas, that all the sales, all the barbecues and patio furniture, everything that all the retailers had over ordered based on their projections from their sales in 2021, all were on clearance. And so that was supposed to help a little bit on the inflation side, but it just means that they just overbought, right? They thought this, what do they call it? The gravy train wasn't going to end, and like all this capacity, inventory capacity was going to work itself out. And I'll give you another example. Nike, they released their recent earnings, and they were saying their inventory levels are completely bloated, and it's actually affecting their revenue because they're just trying to clear out all of their inventory right now. And these are big businesses that are just like basically overproduced back in 2021. Inflationary shock we talked about a lot. Tight financial conditions. This is kind of like on our radar right now. So I'm not sure if you follow it, but there's what are called lending standards. And so there's a survey of all the top bankers in the United States and in Canada, and they look at, okay, you have a bank. What are your lending standards? Are you increasing your total debt servicing ratio or your parameters? Have you increased the beacon score that you need for a particular type of credit facility? So instead of having 650, maybe it's at 700, right? Whatever that looks like for that bank, they can tighten their lending standards, which slows down the economy as well. So just by raising interest rates is not the only way you can slow down the economy. You can also mandate banks to increase their lending standards, or internally they would increase their lending standards. And they do that by looking at their loan portfolio. So how much real estate exposure they have, how much energy, how much forestry, how much production, things like that. So we see that kind of changing a little bit, is that the lending standards have increased over the last 2 quarters. Declining housing starts. So this was kind of a story last year, is that home builders and declining housing starts, and we track US data a lot more. It's a lot more robust data. So housing starts in the US declined. However, that was in the larger single family homes. What they did in the United States, because it's a lot more efficient economy, they started increasing production of multifamily homes. So your duplexes, your bi-level splits, your townhouses and row houses, that increased in production because, again, back to that story of affordability, they know where their customers are. So they're going to pivot and they're going to build what needs to be done. And then kind of the last thing I want to talk about is unemployment. And jobs in North America are plentiful. So we're at the full employment, if not the best employment rate in the United States right now. And when you have a really robust jobs market, you have workers that can quit today, go across the street tomorrow, and earn 10 to 14% more in income. And when you have this wage cycle growth, you also feed into the inflation cycle. So we have really good job opportunities. So there's no recession in jobs. So if the economy were to slow down and certain sectors were to be affected, what our view is that we might see like a rotation, right? We can say, okay, we know housing starts are declining a little bit and manufacturing is declining. So where can those people go get jobs? So there might be a little bit of reduction there. But on the tech side, you heard about all the tech layoffs in the last part of 2022 and the early part of this year. A lot of those workers ended up just getting jobs at better incomes, or if not the same, in the financial services sector, healthcare. They were hiring like crazy. Government continues to hire, and also in like neat places like agriculture. They need data scientists, they need data analytics. Like all of those things are playing into this economy. And so that's why we're seeing kind of unemployment very, very low. And the US Federal Reserve actually said that if they can get to like 5% unemployment, which is like to go to 3.5 unemployment to 5 is massive. And if they can get to that, then they can start to see inflation really leveling off and the economy starting to like hit that soft landing. So I think we're in that soft landing scenario right now with where jobs are at, demographics are at, where manufacturing is. What we're going to see in Canada, unfortunately, is going to be this like rapid increase in debt repayment over the next 3 to 5 years. The average mortgage renewal is going to see a 2.5% increase in their interest costs. That's going to be massive to their budgets. And so I think Canada's a little bit worse off. The US seems to be doing okay. And we can talk a little bit about, I think you're going to talk a bit about AI and kind of like that segment. And so that's where that's going.
Okay, so we are not actually in a recession yet because we don't have those 2 quarters of negative GTB, or are we? Did I understand that?
Yeah, no, we're not technically in a recession
We're
today,
not
but we have
technically in a recession.
recessionary. Yeah, we're not in technical recession, but we have recessionary kind of uh,
Signals.
signals exactly, and like
Yeah. Okay.
manufacturing is a big one. Yeah.
Okay, so that's interesting. Now let's talk about AI. So, AI has been a hot topic. It's
Sure.
been one of the few industries that actually have done well over the last little while in the markets. You can correct me if I'm wrong, but it seems like AI is doing pretty well. It's a hot trending topic. It's there's a lot of different companies. Chat GDP is the sort of big one that comes to mind. How is your firm using AI? And uh, I guess is it helpful for IG to have AI, or is that more of a competitive issue where these sort of like you know um, AI bots or programs are running and saying, well, we'll develop the portfolio for you and we'll change it based on system dynamics and stuff, or is that something that you have already built in, or what's your view on that?
Yeah, so let's back up a little bit and say what is artificial intelligence? So right now what you're seeing is this high demand for what are called learning language models.
Yeah.
And so this learning language model basically has predictive text capabilities. It scours reams and reams of data and resources in order to answer specific questions. So if you ask it, create 10 Instagram posts for me and I'm in the mortgage broker sector and I want to give 10 tips for the average Canadian, it will basically take the wealth of knowledge that's on the internet and create 10 posts for you. So it's for I think for content creation, for idea generation, uh, this specific type of technology, learning language models, is amazing. And so our team utilizes it on a very low level. Give us an idea or list out XYZ of certain things. I used it a lot for my research on behavioral finance, understanding what home bias is or what confirmation bias is, because there's so much literature out there on those types of topics. So it basically can take all of that and summarize it for you. So that's pretty amazing. But artificial intelligence has been around in financial services for decades. Artificial intelligence, as of today, is used to already rebalance portfolios. You can call them algorithms, you can call them factor based investing, you can have trigger rates, and all that kind of stuff is built into not only just lending businesses, but also in investment strategy, investment portfolio management, all of that kind of stuff. We also use artificial intelligence in our financial planning software. So we have what's called the IG Living Plan, where it'll take millions of financial plans that we've designed over the last 40 years, and we can compare, say, one demographic to another demographic or one income category to another income category and see where one financial plan may have been optimized and how we can optimize a current investment plan, right? So if you have Mark and your partner and your situation, our artificial intelligence technology will basically be like, oh, that seems like a very similar plan to like what we're working on right now. So let's see what they did to optimize and where we can help each other. And so it creates this database of like optimal ways to do everything, income, saving, budgeting, all that kind of stuff. So artificial intelligence is already being used in our business. And then let's talk about the industry itself. So AI for, say, financial services is, I think, going to be a disruptor, especially on the admin side. And if you look at what is being disrupted the most, it's going to be those kind of like low areas, the low hanging fruit of admin, data entry, data analysis. Those types of areas are going to probably see, number one, in the short term, a productivity jump. So you can say someone like, I'm a data analyst. I get reams and reams of data every day from my corporation. Let's talk about mutual funds, right? Inflows, outflows, how much is being pre-authorized in contributions, and I need to do projection for the year. Well, AI is going to have like decades of that data to look at, and then an analyst might be able to hit one or two buttons to be able to analyze that. But now instead of spending hours on that data analysis, they might be spending like an hour. And so we're looking at about a 30% productivity jump in a lot of those admin categories.
So you're already using it. That's fantastic. What about your competitors? Is there direct competition to IG, or even on those models that are self brokerage type models? What's the advantage of working with, say, an IG private wealth management advisor versus an AI model or a self brokerage AI model or something like that?
So I think about it's about action plan. And so if you are working with an advisor, you're held to account to what the plan is, right? So that particular, you can almost call it coaching. You can't run an NFL team without a coach, right? You need that guy at the top, like looking at the offense, the defense. They're looking at every single play. Like, what did you do in the last play, and how could we adjust that going further? Oh, you have a change in your circumstances. Oh, you have a small injury. You got to make adjustments. Maybe you have to swap out players, right? So in investment management, most investments has been commoditized, right? You can get XYZ Canadian equity ETF, XYZ Canadian, mutual fund. You can go from blue bank to green bank to red bank to any bank, and they have the exact same products investing in the exact same things. Mm-hmm. What you need is someone to tie that all together, right? And so that's what private wealth management does. That's what IG Wealth does, is that we are the quarterback for all of that. We'll make sure that you get the right tax specialist in, you get the right legal advice. We have what's called advanced financial planning, where we look at these complex situations, and you can't replace that with artificial intelligence. You need actual smart, brainy people that know the law, know what a trust is, and can understand what your unique situation can be applied to a particular strategy. Whereas with anything in this kind of like learning language model is going to take a very cookie cutter approach. And again, we talked about it earlier, is that in the beginning, it really doesn't matter. You can do a lot of those things automated and through AI in the early stages of your life. But as your needs become more complex, and just a simple example is that if you have two, executives that are, say, self-employed, maybe one's self-employed and one's an executive at two big companies, and their incomes are, say, over 400K, and they're a blended family, you can't tell me that AI is going to be able to figure out all of the intricacies of like their intergenerational wealth transfer, right? The wealth transfer that they're going to have to put to these, multiple generations is going to be too complicated for just a simple AI language model to look at. And so that's why you need that people intervention.
I like
so
that.
From a competitive basis, I think AI has its place. It'll help create efficiencies. But on the advice side, we have a very good outlook.
Okay, I want to tie that in with one of the last topics here. I know we're coming up on time, but I really want to get your opinion on crypto. Crypto has been another hot topic. Bitcoin in particular seems to be taking over the world. How does crypto fit into the wealth planning sort of picture? I know it's very new technology, but I mean, it's been around 10 years. There's some people, I think it's Kevin O'Leary, saying it's going to be what did he say? Like it's going to be a whole nother category of asset allocation. It's not going to be commodity. It's not going to be an equity. It's just this new area of crypto. So how is crypto being talked about and discussed, and what kind of advice are you guys giving on that? Is it going to be something in the future? Are people putting 1% of their portfolio into crypto? Where are you guys with this kind of electronic crypto stuff?
Sure, and it's a great question, and I'm going to split it up into kind of three parts. So, crypto as an asset class. So, crypto is technically an asset class now. It's tracked on CNBC and BNN, and it's has some type of value, but that value is really determined by buyers and sellers at this moment. It's not a free floating marketplace like gold is, right? Gold has buyers and sellers, and it's tracked minute by minute across multiple currencies and across multiple countries. Bitcoin is much different. It's literally just valued as to what another person thinks it's valued at. And so when you have no price stability and no projection of its value over the time, and it also has no usefulness, at least with gold, you can mine it out of the ground and you can put it into components. That particular manufacturer is going to say, well, I'm only going to pay XYZ for that gold for my microchip. And so that creates an economy of that item, right? So the first part of it is that some advisors or some investors are including it as an asset class. Like any asset class, it would come with risk. And so no investor should ever have more than 10% of any specific sector or asset class as a higher than that. So that would be like the maximum amount you would ever want to put. And if you really break that down, if you had 100K in investable assets, that's that's a 10,000 bucks, right? Like that's not a ton to invest. That's however many Bitcoins that is. On the second part of it is how are advisors using it? And so this really comes down to a regulatory issue. And Bitcoin is not a security like a stock or a bond or a mutual fund or an ETF. It's not regulated. We've seen tons of fraud and kind of illicit use of that particular asset. Not just in like what the rumor mill says about like moving money around internationally without avoiding tax and government and all those types of things, but also on the exchange side of it with Binance and SBF, like all these guys that just took that particular asset class and created businesses so that they could rake in fees and leverage it and create derivatives of this security. So they did call options, they did all these types of weird things, and they were making money hand over fist creating these derivative of these products. And in the end, they ended up being these huge Ponzi schemes. The retail investor, like the investor, like you said, like your simple investor who doesn't have a ton of money, who just put their entire life savings into this particular thing, has completely been wiped out. They're demanding regulatory change, and that's what we're seeing. The Securities Exchange Commission in the United States is looking at it very closely. They've put most of these companies under investigation. They're now determining whether this is a free floating asset or if it's going to be regulated like a security. And until those types of things work itself out, the actual advisory community, we've stayed away from it for the most part. Our company itself, we would rather invest in they call it the picks and shovels, right? So if you look at the gold rush here in Alberta, the actual prospector digging for gold, panning for gold, made no money. But they needed equipment. They needed shovels, pickaxes, they needed pans, they needed coveralls, they needed to stay somewhere. And so we looked at other businesses to invest in that is providing the technology for this.
Okay.
And then the last part is like, where's the technology headed? Is Bitcoin itself, like the idea of having this, I can't remember the exact terminology, but like having this open source, trackable, infrastructure, I think it's amazing. And I actually believe that in a sense, it's already being used, right? So if you look at, I'm an Edmonton Oilers fan, and I go to an Oilers game, once or twice a year. I have my ticket on my phone, right? And so that barcode from Ticketmaster refreshes every 30 seconds. So that barcode can never be duplicated ever, right? I can't take a screenshot of it and try to sell that ticket to someone else. Like that barcode is live and it's regenerated every time. So that is a level of technology that this Bitcoin is kind of playing on, because it's a single particular barcode, and that is my currency. That gets me into the game. And so the fact that it can be trackable, they can trace it to my phone or to my account, that's where the technology is going to be really cool. So, you can take real life examples of, say, a shipping company from, let's pick a reasonable, like, so I buy something and it gets shipped from Taiwan and that particular barcode is on that item. I can see and track that particular barcode around the world, and my delivery company can check it, my retailer can check it, any type of like industry person can track that particular barcode. So now you can actually like see in real time what's happening with like manufactured goods, or maybe you ordered a car, you've done so well, you ordered that Porsche. Now you have a Porsche with your particular, serial number, and using the framework, or I guess the technology behind what Bitcoin is and Ether is and all those types of things, and you can particularly track your exact components of every single thing that goes into your Porsche. I think that's pretty amazing. And so I think the technology behind it's cool. It doesn't have a place in a portfolio right now. I don't believe it doesn't earn an income. It doesn't pay a dividend. It's just capital appreciation. And if you buy it too high or you sell it too low, then you're just playing that risk game. I would kind of like, why don't you just buy a Rolex watch, right? Like it depreciates in value potentially, right? Like we don't know. We don't know where the value is going to be in 10, 15, 20 years. It's unpredictable.
That's a really good synopsis of that. I like how you explain that within regards to the value is just based on what someone's willing to pay for it. And that makes a lot of sense because a lot of people will say it's the new gold, but gold does have other values other than just, it's sitting a gold bar sitting in your safe somewhere at home. Like technology, you can use it, jewelry, you can use it. So I like that. One last one for you here, Ashish. What are some very general tips you can give somebody who's looking to invest? I think sometimes people think that you need 100,000 or 50,000 or something to start investing, but as you kind of alluded to earlier with 16-year-old or 17-year-old, what are some tips you can provide someone to looking to build wealth at different stages in their life? So maybe in their 20s, 30s, 40s, 50s. Can somebody start in their 60s and start investing? Can someone start in their 20s? What do you got for me?
Yeah, I would probably look at my own situation, right? So I finished school in my early 20s, got a good job right out of school. I was lucky. And, it came with a pension, came with stock options. And I think at that point, if you're lucky enough to have a company that provides those types of options, you need to really pay attention to that paperwork. And I say that because 10 years later, I've looked at statements from someone who started at a good company and their defined benefit contribution pension plan had been sitting in cash for 10 years.
Mm-hmm.
I have helped people with their pre-approvals of mortgage. So I worked at a big bank before and I did mortgage lending myself and line of credit lending. And you'd come in and you try to pre-approve someone with a mortgage and they would have like maxed out credit cards, not just one credit card, like 5 credit cards.
Mm-hmm.
So I would say the biggest tip for investors is understand your balance sheet and understand what you're paying for. Look at your wants and needs. And I have bought into this philosophy that when you're young, you need to work as hard as you can to make as much money as you can. You are young. You don't have to sleep as much. Your recovery time is less. And I made a lot of mistakes in my early youth of, not valuing my time and where I was getting income from and spending more than I was making. And I think if I were to go back in time, I would work way harder, make more money, save a lot more so that I had a lot more freedom in my 30s. So, stage one, work hard, make income, find streams of income, self employed. Like, this is the top time for you to take risk, right? If you have, want to start a business or you want to like compete somewhere or travel or get educated, like, get it all done early and save at least 10% of your gross income, at least. Like that's a non-negotiable. In your 30s, that is where life changes start to happen. And so let's define the life changes. You got buying a house, getting married, there might be a death in the family. So maybe you're blessed with an inheritance, maybe you're not. Maybe you have, parents that have high debt and you're just kind of like navigating that in your 30s and 40s. And then you have job changes. So the average call it Gen Zer is staying in a job for 2 to 3 years versus the previous generation was like 7 years and the previous generation was like 25 years, right? So as you change jobs and you're looking for, that next best thing, really have it aligned to your values, making sure that you're passionate about what you do. Because if you hate your job and you're not making good money, you're just going to hate your job and you hate your life. So that's kind of like phase two. And then now, like, I'm in my 40s, I've got a young family, I've got house, car payment, all those types of things. I watch my balance sheet very closely. I know what I owe, I know who I owe, and I know what I need to save. And you need to have that number. And I think this is the sweet spot in our generation where you can really start to say, okay, I'm 40 now, and in 20 years, if I want to just not have to work or at least have the freedom to just change jobs or open a business, I know I'm going to need X dollars, right? So my number is 2.2 million. Like I need 2.2 by the time I'm 60 to do anything that I want to do at that age. But I don't want to stop working. I love what I do. If I could do this job, what I'm doing now, I could do this for another 20 years and I'm going to get so good at it, right? Like, because I'm trying to master what I'm trying to do. Mm-hmm. And so that's the same with the, young investors today is just like start early, love what you do, work hard early when you're young and youthful, so that you can chill, right? Like you can chill in your 30s and 40s. Like I really wish that more of the young generation would hear that.
Hindsight is 2020, isn't it?
It is totally, totally.
But then we would have missed out on all the high school parties, man.
I know.
Okay, well, that's been great. This last part of the interview here is something I call the speed round or this or that. Just a fun way to end the interview. Very loosely and light, just so people can get to know you on a deeper level. And I think I'm going to make some sort of video on this at the end of the year or something, like bloopers or something. So just got a few questions for you just to kind of hammer this home. Ready to go?
Ready.
Okay, so you don't have to give an explanation, or you certainly can if you'd like to. First one is house or condo?
House.
Fixed or variable?
Variable.
Hmm. Even today?
Not today, but I rent
Overall.
just like you, and so if I were to do variable, I'd be locking in high, the potential for a low. Like
Yeah.
that's yeah.
Coffee or tea?
Tea.
Any favorites?
Right now, I'm sipping on just Earl Grey with cream and sugar.
A nice Earl Grey.
Yeah,
I'm a tea guy myself as well. Lift weights or run?
lift weights.
And you can say neither. The last like five guests have said neither. So, morning or evening?
Oh, evening.
Evening cat. Uh, BMW or Mercedes?
Neither.
Either. That's a new one. Okay. What is your favorite pastime or hobby?
Ooh, it's a tricky one. Beach volleyball.
Really?
Yeah, I miss beach volleyball a lot.
What music are you listening to these days?
I'm
Bands,
actually
songs, artists, genres.
I'm into this Canadian rapper. Two of them actually. One is Dax, and the other one's Connor Price. He's huge on TikTok, and I've actually fallen in love with Taylor Swift. So I'm listening to a lot of her stuff lately, especially because the kids love that, and it's fun for the family.
Good to know. Last one is what's the last book you read?
The last book I read was fiction. It was called Artemis, and it was from the same author that did The Martian with Matt Damon,
Hmm.
Andy Weir. And I don't read books, but I made a commitment in 2022 to read 10 books. And
A
when I say
year.
read, 10 books a year, but when I say read, it's audiobook slash reading. And so last year I read 12 books,
Wow. Good for you.
10 nonfiction and two fiction. And I can't remember all of them. Some of them I sped through, but my nonfiction ones were, mostly around economies, and some interesting stuff, data analysis, things. It's cool stuff.
Do you have a favorite nonfiction book?
Ooh,
One that's maybe changed your outlook on things?
let me just give me 2 seconds to Google the title. It was about how businesses can rocket into these huge businesses, and the title escapes me. And so, if you give me a second, you
Sure.
can cut some of this out.
I am a fiend for nonfiction, and I don't think I've ever read a fiction book, to be honest with you. Maybe
Yeah, I read like my
is the
favorite
what is the
nonfiction was Forrest Gump.
yeah is the Wealthy Barber fiction?
That would be nonfiction, I think.
Okay. So yeah, I'm pretty much all nonfiction. Lately, I've been into like longevity and the health span and things like that. Sort of in the sort of health. You get to your 40s and you start mapping out your life, and you do this all the time with your clients. And what are you going to be when you're 50? Like, how old are your kids going to be when you're 60, 70, 80? And so I've been into that stuff lately.
Yeah. I don't have the book title offhand because I'm on a new computer, so I have to go to my notes app.
That's okay. We'll get it from you later, and I can post it in the comments of the notes
Yeah.
there. Last one. Where can people find you?
So I'm a corporate employee, so ig.ca is our website. We have a weekly podcast, so go to the IG Living Market podcast on Apple, Spotify, Google, we're everywhere. And we do our weekly blog, which is called The Week in the Markets. So those are the three areas. IG.ca has all of that, and you can find me there. I'm based out of Edmonton, but I do travel across the country. My next stop is going to be Kelowna, Regina, Winnipeg, Calgary in September. And so I'm booked up for some speaking engagements all through the rest of the year.
Are you on social media?
Yeah, I'm on social media. You can find me on Twitter at retirementguy81, and I'm on LinkedIn.
Awesome. Well, thanks again for doing this today, Ash.
Yeah, you're welcome. Thanks, Mark.